Welcome to the weekly market recap with Sampath Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. Sri Lanka is expected to maintain both primary fiscal surpluses and current account surpluses over the medium term, according to the World Bank's Global Economic Outlook 2026. The report states that this outlook is supported by strong revenue performance, lower global oil prices, and resilient worker remittance inflows, even as overall economic growth begins to moderate. According to the World Bank, Sri Lanka's economic growth is projected to slow to 3.5% in 2026 and further to 3.1% in 2027. This deceleration is attributed to structural constraints, including inefficiencies in factor and product markets, lingering effects of the economic crisis, and global uncertainty weighing on export demand. Despite the slowdown, the projections are marginally higher than the World Bank's outlook released in June 2025. The bank has revised growth estimates for 2025 and 2026 upward, reflecting improved macroeconomic stabilization. However, the report notes that the projections do not yet factor in the economic impact of Cyclone Ditwa, as assessments are still ongoing. The World Bank Group has estimated initial damage from the cyclone at $4.1 billion, equivalent to 4% of Sri Lanka's gross domestic product in 2025. On the fiscal front, the report highlights that strong revenue performance is expected to support reductions in fiscal deficits and public debt. This reinforces expectations that the government will continue to run primary surpluses as part of its fiscal consolidation efforts. Externally, Sri Lanka is forecast to record current account surpluses, mainly due to lower global oil prices and steady remittance inflows. The World Bank notes that remittances from member countries of the Gulf Cooperation Council are expected to remain resilient, providing a buffer against external financing pressures. However, the outlook remains constrained by structural and demographic challenges. The report warns that immigration pressures are likely to stay elevated, particularly among young and highly skilled workers, posing risks to medium-term growth and productivity. The World Bank also flags global trade risks, cautioning the high tariffs, additional trade restrictions, or increased uncertainty around global trade policies could weaken export demand. While South Asia's overall trade openness remains limited, the bank notes that economies with great exposure to the United States, including Sri Lanka, face high risks if tariff increases or the removal of trade exemptions were to occur. Sri Lanka's manufacturing and services sectors recorded strong expansion in December 2025, despite disruptions caused by Cyclone Ditwa. This is according to the Purchasing Managers Index compiled by the Central Bank of Sri Lanka. The PMI for manufacturing recorded an index value of 60.9 in December, indicating a continued expansion in manufacturing activity. All sub-indices contributed positively, supported mainly by seasonal demand, even though adverse weather conditions disrupted activity at the start of the month. New orders and production increased during December, driven largely by the manufacture of food and beverages sector. Employment levels and stocks of purchases also rose in line with the strong production and new order volumes. Meanwhile, suppliers' delivery time lengthened further, reflecting high demand for input materials and weather-related logistical delays. The central bank noted that expectations for manufacturing activity over the next 3 months remain positive, supported by anticipated improvements in overall economic conditions. Turning to services, the PMI for services rose to 67.9 in December, indicating a sharp expansion compared to the previous month. Business activity growth remains strong despite early month weather disruptions, supported by robust performance across most service sectors. Wholesale and retail trade emerged as the main driver of growth, supported by festive season demand. Additional momentum came from other personal services and accommodation, food and beverage related activities. New business volumes increased during the month, supported by stronger activity in wholesale and retail trade and improved performance in financial services. Employment in the services sector continued to rise as firms expanded their workforce to meet year-end operational requirements. At the same time, backlogs of work increased for the second consecutive month. Looking ahead, expectations for business activity over the next quarter have turned more optimistic. The central bank attributes this outlook to favorable macroeconomic conditions, seasonal tourism-related factors, and the gradual normalization of operations following recent weather-related disruptions. Sri Lanka has recorded foreign direct investment inflows of over $1 billion in 2025, marking the first such achievement since the economic crisis. According to the Board of Investment, total FDI inflows reached $1.057 billion during the year, a 72% increase compared to 2024 and slightly above the official target. The improvement comes amid macroeconomic stabilization under the IMF program, easing inflation and a more predictable policy environment. However, data shows that the recovery remains uneven. Only about 16% of total inflows came in as equity capital, while the majority consisted of intra-company borrowings, foreign commercial borrowings, and reinvested earnings. This indicates that much of the inflows was driven by financing within existing multinational operations, rather than new risk capital entering the country. Investor caution is also evident in the split between new and existing projects. Of the 189 companies that invested during the year, only 26 were new projects, contributing just 13% of total inflows. While this represents an improvement from recent years, most foreign investment continued to come from expansions of existing operations rather than large greenfield projects. Looking ahead, the Board of Investment has approved 146 projects valued at $1.9 billion in 2025. Around $896 million is expected to flow in as foreign capital over time, forming the basis for government's $1.5 billion FDI target for 2026. However, the report notes that actual inflows will depend on execution, with past investments often facing delays due to regulatory infrastructure and financing constraints. Global economic growth is expected to remain resilient over the next 2 years, according to the International Monetary Fund. In its latest World Economic Outlook update, the IMF projects global growth at 3.3% in 2026, easing slightly to 3.2% in 2027. These projections are broadly in line with estimated growth outcome for 2025. The IMF noted that the forecast for 2026 reflects a small upward revision from its October outlook, while expectations for 2027 remain unchanged. According to the fund, the steady global performance reflects a balance of opposing forces. Headwinds from shifting trade policies are being offset by strong investment linked to technology, particularly artificial intelligence, with momentum seen mainly in North America and Asia. The IMF also said global activity continues to benefit from accommodative financial conditions, along with fiscal and monetary support in several economies. In addition, the adaptability of the private sector has helped sustain growth amid global uncertainty. On inflation, the fund expects global headline inflation to ease gradually. Inflation is projected to decline from an estimated 4.1% in 2025 to 3.8% in 2026 and further to 3.4% in 2027. The IMF noted that inflation in the United States is expected to return to target more slowly than in other major economies, with forecasts broadly unchanged from October. Despite the stable outlook, the IMF cautioned that risks remain titled to the downside. It warned that a reassessment of productivity gains from artificial intelligence could weaken investment sentiment and trigger sharp financial market corrections. Such a development, the fund said, could spill over beyond AI-related firms and reduce household wealth, posing broader risks to global economic stability. Let's take a look at this week's Treasury Bill auction results. With the recent Treasury Bill auction, the 91-day T-bill rate stands at 7.93%, down by 2 basis points. The 182-day T-bill rate stands at 8.36%, down by 8 basis points, and the 1-year T-bill rate stands at 8.47%, down by 1 basis point compared to the previous week. Thank you for watching. We'll be back next week.